folks. Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory, coming to you today with a little market update, kind of let you know what's out there. Fed, obviously, dominating the headlines this week. Yesterday, they announced that they were going to raise the short-term interest rate by 75 basis points. And perhaps more importantly, they came out with a very hawkish tone on the pace of interest rate increases, sort of through late 2023. Basically, most folks now expecting the Fed to raise by probably another point this year. And then ending somewhere around 4.5% plus or minus in 2023. Which the Fed believes is necessary to kind of feel the economic pain or fuel the economic pain in order to slow the consumer down and slow inflation down. So a hawkish commentary out of the Fed, and probably a little more hawkish than maybe what people were hoping for. But I just remind folks, we've been saying for a while that in order to tame inflation, you're going to need to feel some economic pain. We're going to need higher unemployment. We're going to need people less willing to buy cars, is the analogy that we've used before, people less willing to spend money on houses. And raising interest rates in this fashion is certainly having that impact. And it actually speaks to the strength of the underlying U.S. economy, that we've been able to raise rates as rapidly as we have, while still seeing very low unemployment and continued strong inflationary pressures. Just speaks to the magnitude of what the Fed is dealing with as it tries to quell inflation. This is a very double-edged sword. On the one hand, the economy is very strong. Which means that the Fed, in order to quell inflation, needs to be fairly aggressive and can afford to be fairly aggressive as it attempts to quell that. And I think the glass half full optimist would say, okay, well, if the economy is very strong, as the Fed starts to gradually decrease the rate at which it increases the interest rates, they'll be able to cool the economy without necessarily freezing it. And we might be able to engineer a soft landing out of this thing. The glass half empty would say, look, the Fed is going to need a recession in order to kill inflation. And once they get a recession, then we'll be able to talk about what the future looks like. I would just note that the dot plot that the Fed has put out does not assume that we get a recession. And Powell was very clear in his comments yesterday that they are very data dependent. If they see unemployment start to rise faster than what they have predicted, or if they see inflation start to cool faster than what they have predicted, then they will make adjustments to their interest rate predictions accordingly. And in fact, that's what you saw yesterday. The economy has actually been more resilient than I think a lot of the Fed thought, and as a result, they raised their interest rate expectations in response. 12 months is a very long time. 9 months is a very long time. And so it would not surprise me to see that interest rate picture continue to evolve as the Fed determines exactly how the economy is behaving, or as they see how the economy is behaving. In the meantime, as I just look at the third quarter, wow, what an up and down ride it has been. It's interesting, even with yesterday and today's sell-off, we are basically where we started back on June 30th. So when you see your quarterly statement, you probably will see most values largely unchanged for a trailing 3-month period. But wow, what a rally. S&P 500 up about 15% intra-quarter, and then giving it all back in the second quarter. In the second half of the quarter. I think that speaks to, one, the difficulty, obviously, of trying to time the market with any of this. But I also think it speaks to the willingness of the market to trade up dramatically, or the inclination of the market to trade up dramatically if it thinks that this inflation beast is behind us. Right now, everyone is geared up for the notion that inflation is here to stay and going to be there for a long time. feels like, if we were to see a surprise to the upside on maybe a little bit higher unemployment numbers or a little bit higher, lower inflation numbers, that might give the market hope, and we might be once again back into this good news is bad news is good news type of news cycle. In any event, as always, if you have any questions, please feel free to reach out either to myself or to your advisor directly. I hope you're having a great day, and I look forward to talking to you soon.
Thank you for tuning in. And if you're enjoying this content, please don't forget to subscribe and click the bell so you can keep up to date with everything new at RFG. If you want to learn more about who we are and what we do, please visit our website at rfgadvisory.com.